Hello and welcome to the Investing Master Series. My name is James Boyd. Alongside with me is my good Canadian friend, Barbara Armstrong. We welcome her here as well. We got many of you. Olga, welcome to you. We also got with us, aloha back to you, Scott Luck. Scott, is it raining in your neck of the woods? I saw that coming there. Maybe, hopefully it's going to dry out before I get there. Boy, look like the boat. I mean, when you're using the boat on the land, that's when you know it's pretty bad. And also, Kevin, welcome back to you. GT or Gary Taylor, Richard, Greg, Bill Barnhoff, and many others. Welcome. Good morning. Now, just real quick, this is not a one-off class. We meet each week together to talk about markets. If you have some questions, go ahead and type those in, and we'll answer those along the way. Barbara is going to be in the chat full time. I'll be actually watching the charts and the chat at the same time. Remember, you could follow Barbara and myself on X if you go to this page. Let me put this in the chat here. There's Barbara's actually page, the link for it. And we do post educational content daily and announcements. And also, you're going to see there's my link right there. So you can just click on them. And also notice that if you go to this page, if you're not subscribed to the Trader Talk channel right on YouTube, just go ahead and do it. Simple thing to do. It's free. And that way you can also access all of our content right on your mobile device. Do not have to be on a computer. Now, also, as we get going here today, remember that we'll talk about stocks and options. Remember that options carry a high level of risk and are not suitable for all investors. Understand there's different types of option strategies for different reasons, different goals, different risks. And also remember that the information provided here today is done for general informational purposes only. Schwab does not recommend the use of technical analysis as a sole means of research. Other types of research is very interesting. Technical is interesting, but other type of analysis, very interesting as well. Join us on the fundamentals tomorrow. Now, just real quick as we get started, we'll be using the Paper Money software application. When we talk about investing, we want to understand what is the risk of that trade and also talk about the potential risk of loss of principal. Now, when we talk about our examples here today, we'll talk about maybe, let's say, short options, whether that could be, let's say, like a cash secured put. Understand that can be a sign, which means you're buying the shares prior to expiration. And also understand that we're just talking about a short put, okay? If we had a short call, that could be the, you have to deliver the shares at the strike price. In our examples here today, we'll talk about short options as far as buying the shares at the strike price. Now, whether it's at expiration or not, okay, it's a standing obligation. Now, also remember when we talk about our examples, we'll talk about markets first. We've really been focusing a lot on crude oil, the VIX, interest rates, and the US dollar. Those four charts are probably going to tell you where the broad market is going, the SPX that is. So let's go ahead and hop right in and look at those four. Now, let's start with crude oil first, okay? Now, you might be kind of thinking to yourself, I don't trade oil. Well, as you've seen in the last couple of days, oil can affect other things. Now, the biggest thing is we're not trading crude oil itself. We're looking at the price of crude oil for the April delivery date, and you're going to see that it's affecting other things like retail, consumer discretionary, things like that, stock market in general. Now, if you look at this, this has been the first time. This would be a welcome candlestick, and also seeing the price get down below the short-term moving average and the 20-period moving average would be a welcome sign of many investors, okay? Now, we can't maybe get the trophy yet, but seeing at least the price on the south side of the moving averages, that pressure, if you will, many investors would like that. Now, I want to keep in mind that when you look at the IXE today, that's not hurting. What's kind of interesting is it was the price of crude oil that went up first. And you saw the energy sector, which is stocks, they went a little sideways. The energy sector itself and individual stocks, they're actually getting a decent move here today. Now, they've been moving the last 3 days, but the biggest actually thing is better move today. Now, I need to know from you, what stocks in that area are you watching? I won't tell anyone. It's just me and Jax here. Now, the biggest actually thing is when we also go back to like, well, what about volatility? Well, remember, the volatility is like a balloon, right? We keep blowing air into that balloon. Eventually, pops, and maybe are we starting to get that? Now, remember, when the volatility is up, it doesn't mean stocks can't keep going down. As we saw, that just because it's high, it can't go higher. It can. But volatility, seeing this kind of negative. Now, if in the last, let's say, 7-10 days or so, you start doing selling strategies like cash secured puts, short put verticals, etc., you might have been a little early. Dale Reeves even said JB is always early. That's just the way I am. I'm always kind of thinking the counter. Now, the biggest actually thing is when you take a look at this is kind of interesting to see this on the south side of the moving averages as well, and a crossover. Now, remember, you got to think about if we saw this happening, this might be a better setup for stock investors. If the VIX is actually dropping down, that probably means stocks are going up. More stocks are going up. The breadth of the market is actually probably becoming a little bit better. You're probably seeing diagonal resistance breakouts. If the VIX is crossing over negative to the downside, stocks are probably crossing over bullishly on their moving averages. When we also take a look at the US dollar, that US dollar, I mean, I'm not sure if I would say it was like completely like big smash to the downside, but at least coming off that 150 level. And if we look at the last one, the TNX, let's pull that up. Yeah, TNX CGI, you're going to see that had a better drop. So these four charts, okay, you want them to start going down. If they start going down, the likelihood of that SPX actually going up is probably a lot higher. Now, we have not been above. This has been, how long has it been? Well, the last time that we were above a 20-period moving average where we closed there was on February 26th. That's like 3 weeks. Now, if we're talking about intermediate pullbacks, it's not unusual to get maybe a 2, 3, 4 week pullback. It's not unusual. But if we can close here, okay, well, this would be the first time we've actually got above and closed above since the 26th. Now, you're going to notice that if we go back and look at about the last week or so-ish, maybe also going back the last 2 weeks, we're pretty much in this same range. So when that VIX doink popped to the upside, we're right back to where we were before. So this is kind of interesting, a frustration for the bears. The bears actually get in, they try to smash it down, and yeah, there's some volatility, but the question is, did they really go down? If you're a bullish investor, you probably treaded water, and you're probably where you were about 2 weeks ago. But the thing is, you maybe just kind of weathered through that storm of volatility. Now, when you get the volatility spikes, you're sure hoping that you have a purse in hand, a wallet, a fat one, where you're saying, look, I'm getting some opportunities here to maybe consider some new entries. Now, if we take a look at also the SPX EW, okay, the equal weight, we are also seeing that finally get a little bit better turn. Remember, this is looking at all sectors equal, being equally weighted. Example given 10%, 10 sectors, 10%, getting a little bit better push. Now, I want to just go back to just real quick. Remember I asked the question, like energy stocks, like which ones? Now, if we went to that market watch for just a moment, and let's go to the S&P 500. So I went to the market watch, and then I went to visualize, okay? If we go to visualize right there, this is just going to give us that 30,000 foot view of what's really out there. Now, again, these white boxes, the sector, right, and so on. So now we can also, if I look on this and say, what do we got? There kind of looks to be like in the consumer discretionary area, there's some green in there, okay? Now, when I look at that, I'm kind of seeing something like Marriott, Hilton, Airbnb, Booking, so on, right? Healthcare's gotten a little pushback. There's the energy space, which will isolate, but we're getting a little push there. And where we're also getting a little push, some of those financials might be getting a little bit stronger. But remember, if you go back to, let's say, where are we seeing that lighter color green? There's the WDC, there's the STX, right, that we talked about yesterday, still green. And you're seeing Palantir, Micron, we talked about yesterday. There's some movement in there. By the way, one that's getting a little push there is On, okay? Now, I want to go to the left-hand side and let's click on the energy, okay? So what this does is instead of just looking at the 30,000 foot view in a plane, looking down, I'm saying, look, just get me to that neighborhood, okay, of energy. Now, what I want to do is here's the thing. We cannot say that there's not been some opportunity. We can't say that. So when I go look at a couple of these stocks that are in the list, and let's detach this for just a moment. On the right-hand side, I detached it, okay, detach. And I'm going to put that back to, let's say, it's on my other screen now. That's why I'm looking to the right. And so now what you're going to see, if I pull up, let's say, a couple of these stocks, I just have that grid on the right-hand side, okay? Looking at the camera, okay? But that's why I'm looking to the right. I'm going to take what's on my right, and I'm going to put it actually in front of us. So stocks like Chevron, nice little push, okay? Had a nice little crossover. The thing that happens with crossovers when the volatility is up, people doubt the move, so they don't trade the technicals, even though they say they're technicians. Are they? Or are they trading their feelings? Okay, Chevron getting a little push. I'm going to just fast fire through a couple of these stocks. ExxonMobil, a little push. Tippy-toeing all over that 10-period moving average in the last couple of days. There. Someone, plural, okay, buying off that brand new high on the Chevron. Now, I'm going to go to just this couple of these names. One that kind of came up in that list was FANG. Now, let's kind of start here for just a second. Now, here's the deal. Whenever you talk about investing, if you don't really know what they do, the likelihood of you getting in is extremely low, okay? I mean, if someone said it's $5,000 for what? You got to at least know, what do they do? What have they been doing? So if we go to analyze and then fundamentals, this is really going to give us an idea of what they actually do. What are their businesses? Where are their businesses? What's the company website? Where can I find out some more information as far as investor relations, PDFs, anything like that? PowerPoints recently done explaining the company's position. Now, if we pull this up just real quick, I'm going to go back and we're going to look at this first example. So first off, what I want to kind of do is when we look at this, there's been these Cajole dots, right? Now, if we said, what was that trend? The trend has actually been fairly decent. Now, we got to ask ourselves, what was the area of resistance? What would you say on this chart? What was the area of resistance? Well, that area of resistance, if it had one, was probably right around this vicinity of maybe 183-ish. So we're in that process of trying to smash through that resistance area. Now, a lot of people say, I want to see a breakout. Dan, I want to see a pullback. It's like, look, come on. We're not going to live to 150 for all that. So some investors say, look, I'm just going to start to build a position. If there's anything that you've ever learned from me, stop thinking that you have to get in all at once. This is like a relationship. It's like when I dated my wife. I didn't just say on that first date, here's the $10,000 ring. Okay? My name is James, by the way. We think we do that with investing. It's foolish, maybe. Some investors say, look, I'm just going to go on one date with the stock, go on the second date, maybe kind of ask for a little bit more commitment, blah, 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 meet the family, whole 9 yards, etc. Have a fight, see if you can bounce back, the pullback, see if you can make that higher low and keep that upward trend. Don't act like I'm not the only one. So the biggest thing is when you take a look at this, okay, is overall is there's been able to be pullbacks, but it made higher lows, which then made that upward trend. Now, we can't assume that there's options on it. We got to go look. So first off, 661,000 shares traded keyword so far. When we take a look at, let's say, the liquidity on this in terms of the options, bid-ask spread here, 80 cents. You got 90 cents. This is not, it could be an option trade if you like to trade more illiquid options. This is why sometimes that when the VIX is high, you think, oh, you could have just done options. No, we've been recently showing that when the VIX is really high, those options are maybe not as attractive, okay? Gonna go to charts. We're going to right click on this. Now what I'm going to do, buy custom, and I'm going to go down with stop. Now, my brother, he didn't listen to my analogy. And if he was with me here today, he would say, listen to James. Okay, here we go. Now, in this example, we're going to buy Fang. Now, I got to bring this up. Let's go back to that. Let's pull it up in this, and I at least want to look at one or two energy, and then we're going to switch to technology. I'm going to right click on the ask price, buy custom with stop. Okay. Now, when I do that, I'm going to go back to the amount of capital. If we said, look, we're willing to invest, and let's say our full amount would be $4,000. Well, I'm not going to put full amount. I'm just going to take the stock on a little date. I'm going to say, look, I just want to make sure you're trending in the way I think you are. And I want to see if you can't make a higher low and bounce back to the upside. So in this case, I'm not giving a full commitment of capital. We're only giving half the capital. Okay. Now, this is also a way to kind of think logically and not emotionally. Boy, that could be a whole class just on that. Okay. $2,000, which is about 10 shares, building a position. Now what you're going to see is there's the ask price. We don't have to maybe buy at the ask. We might say, could we get it a little bit lower? Like where? Well, it's probably about 187.25. We could try to get that filled there. There it is. I'll put it right there. And the stop underneath is really probably that diagonal line. That diagonal line, you could almost go back to connect these dots, as many of them as you can. And if I go dot to dot to dot, I'm getting a number of these. I'm getting the vicinity of where that trend line probably is. If I take 178.54, type it in, 178.54, less 2%, it's going to be at 174.96. Now, a lot of people ask me all the time, how do you find stocks so fast? Man, you've got to look at the futures list. Then you look at the indexes. And then you go to the sectors. And then you can visually bring up, okay, the visual list of the S&P 500 and start to kind of get the areas that are getting some strength. Okay? You do not have to become a search black belt master. You need to master the basics. And if you master the basics, you'll find the stocks. Okay? From those stocks, then we're asking ourselves the question like, are we getting a bounce? Well, there's the Cahol dot. Are we getting a brand new high? Yes. Okay? Bounces, breakouts, crossovers. It's the same thing, and it has been for 25 plus years. More than that. But that's how long I've seen it, maybe 30. The biggest thing is if we go back, what is that stop again? That stop is at 174.96. Now, are there any questions on your side? Yeah, okay. Question was, do you review current positions? No. Oh, yes. Yes, we do. Now, let's go to this just real quick. Now, when we talk about current positions, we might also be asking ourselves, when we look at the positions that are in the portfolio, what do we own? Okay? That's a big question. Okay? In other words, what is in the portfolio, are those areas where there has been or currently is some strength? Now, if I actually go back, example given, I'm going to pull this back up, go to the monitor tab. And if we look at this just real quick, I want to see if there's any positions that we just put on, and I can spend some time moving those up. But if we looked at this, our positions are really broken down into what type of strategy they are. Like stock, okay, non-option, long synthetic. Option, stock like, not the same, similar. And now you're going to see like verticals, etc. So if we take a look at this, absolutely, we'll talk about some positions. Now, I want to go back down to just real quick, one of the positions we talked about, I want to go back to a couple of these names, such as WDC for just a moment. Now, if you look at WDC, what you're now going to notice is we talked about the Seagate STX, okay? We talked about, for example, we talked about SanDisk, SNDK. Talked about that one yesterday. The WDC, if you look at that, You're now going to notice if you take a quick peek at that, that's the one that's actually gotten a little push, pretty good push here to the upside. And what you're now going to notice if we look at, let's say, another one in that area is STX. Now, I want to look at this example given. Now, we can kind of be in this area of technology. It doesn't necessarily mean that we don't know if they're going to be stock or options. We don't know that. Now, the biggest thing is when you look at, let's say, Seagate, this is really broken above a level. Now, what I'm trying to do is on these charts is I'm trying to really assess, are they setups? So when you take a look at this, you'll actually see that, hey, there's a recent bounce. We talked about the candlestick types. We talked about the moving averages, right? And if you look at the moving averages, we had the crossover. We see the moving averages going green with the green shading. We know there's been buying pressure. Now, if we go, let's say forward, let's say one chart in, you're going to notice that in the shorter term, the dotted lines represent days highs. The days highs are really, in this case, going to be 10-day high, which is the orange line. 20-day high, really being the blue line. 55-day high. Different durations of time for breakouts. What have we seen in the, let's say, the last 2 days? Answer. Well, we saw a breakout line on the last 10 days. Now, let's not make this complicated. If it's really moving to the upside, you should be hitting short-term highs. Does that make sense? So, now, by the way, we have that on the column script. It wouldn't be that hard to see that. We have the 20 and the 55, but we could add the 10. That wouldn't be hard at all, okay? Now, when we look at Seagate, we're going to go to this real quick and just double check the options. We're still seeing them $1 wide, okay? Now, in this example, we might say, geez, $1 wide on those, $1.20 over here. Now, it is higher price, but still we're seeing the lingering effects of wider bid-ask spreads. What does that really do? Why does it matter? Well, if I'm trying to get in and out, get in, get out, get in, get out, it's tougher to get in and out because the spread is wider. It's like if you bought or sold cars, you bought or sold houses. The wider the spread of the commission, so to say, the more you have to hold on to it typically to get a move in your favor to offset the commission, okay? But if that was narrower, you could try to get in and out and not have to hold on as long to overcome the commission, okay? Now, in this example, we're going to go back to the chart, and what we're going to do is we're going to right-click on the chart. When we right-click on that chart, we're going to go down to Buy Custom with OCO Bracket. Now, if we go to, let's say, this with OCO Bracket, you're now going to see that we have, let's go back to this. We're going to build a position again. Now, on this, what we're going to see is we're going to go back to, let's say, not the $4,000. We're going to say $2,000. Now, remember, we're trying to really teach that idea of adding to the positions. Now, if we take a look at this, building a position, adding to the position. Now, if you take a look at this, what's the top side? This is really your classic stock breaking inside the old channel area. So very important here when we actually take a look at this. So if we went back and said, okay, what we got in this case is, let's say 452, we now actually come underneath and say, what has been the area? What's acting like potential support? Now, I'm going to tell you what happens, okay? When markets sell off, volatility goes up, people's mentality goes in the garbage can. People are putting their head down and they're not paying attention. The time that you want to pay attention the most is actually when the volatility is the highest, because that's when you're in the peak state of opportunity. But if you emotionally, mentally, financially have put yourself there down, you cannot see the opportunities. Okay? Now, James, did you know that initially? No, absolutely not. No one told me, hey, when that volatility goes up the highest, that is when you are in the peak state of opportunity. Now, there's reasons why people kind of get there, okay? Number one is they never exited any of their positions. They don't have any defined risk trades. They're all in on certain one or two sectors or one or two stocks, and the market has pulled everything back, and your goal at the end of the day is to try to get to break even. You want me to keep going? How do I know such things? Because I've been down that dirty, dusty road, and it's a dead end, okay? and it's usually not a great outcome. So the biggest thing is we want to talk about stops. We want to talk about downside risk protection, Mary puts, collars, right? Hedges, things like that that can just get us through the volatility storm without really breaking the portfolio. And it hasn't, okay? Now, if we take a look at this, what you're now going to do, we've got a target, stop underneath. If we took, let's say, that 396, if I took, let's say, I'm going to put 393 right where my pencil is there. 393.16 less 2%. And if we did that, it's going to be 385.29. So 385.29 dated GTC. Okay. Now, what would be an add point? An add point might just be like a red candle, followed then by another green candle. So if I were to draw this up, let's say tomorrow we get like a red candle and the investor goes, oh no. And then you would say, no, James Shaw is better than that. That red candle, that is the opportunity for what? That's the opportunity for a brand new hold, okay? Red candles above the moving averages, they're nothing, okay? They're just a down day for that day. Don't fold like a cheap lawn chair whenever you see just a red candle. And why do I say it like that? We see red candle and all of a sudden we just completely forget everything. The red candle above the moving average, that's the setup for the bounce. So if we get a red candle that's above the moving average, we're thinking, man, I might get a cold the very next day. I'm watching now. And all of a sudden, if we do that, that's the bounce. So if today we're trading the breakout, tomorrow we get the red candle, we're not mentally going in the garbage can, so to say. I'm thinking, oh, I might be getting a second entry setup. And all of a sudden, let's say Thursday's like this. This is Wednesday, hypothetically. This is Thursday. I'm thinking, man, I got a breakout, entry number one, red candle, set up, and actually here's Thursday. And the investor says, look, I built a position right here. Now, how do you know it doesn't go down for 2 days? It could, okay? But the more of the story, I'm just showing you, the investor's just looking for a brand new bounce setup, okay? Now, if we take a look at this, the question from Dean is, are we looking for the red candle at the closing bell? Look, we want the red candle for the day, So in other words, if I went back and let's say example given, look, let's say we bought a breakout here, okay? Breakout. And the very next day, red candle. Oh no, horrible, terrible. Okay, get a hold of ourselves. Well, now all of a sudden you're going to see, well, remember with what we just said, okay? Could we get a bounce the next day? Well, we start to get a bounce. Red candle close higher day. Is that a hold? No. Well, what we got to do is, so this is a classic example where there's two bounce type of setups, main ones. Hold, which is a 1 day bounce. Close higher gap is a 3-day pattern. Red candle, green candle, that is not hold, and then looking for, let's say, the gap entry. There's the gap entry right there. Now, if someone said, I didn't see that because I had to take puppy to the vet or whatever, or go work out, you're going to see that the investor missed that entry. But by the end of the day, what was it? It was a hold. So when we talk about the red candle, we're not talking about, let's say, just intraday. We're talking about the day the candle was red. Okay? All right. Any questions there? Yeah, no more emotions today. No more emotions. Look, I'll tell you what, I think you got to tie the emotions into it because in investing, it's dealing with capital, right? And if you don't kind of get a hold of your emotions and logically think through things, well, you tend to kind of do some things you say, geez, it wasn't the greatest. So if I went confirm and send, and now what I'm going to do is going to go ahead and I'm going to try to put that position. I'll fix that. But the biggest actually thing is that was STX, okay? A little bounce. So Dean, hopefully that answered your question. Now let's go back to something just real quick, okay? Now, example given. Let's say the investor said, you know what, James, what about some of these positions that let's say are underwater somewhat? And let me just kind of show you an example. Now, earlier in the year, we did some classes on like strategies, right? So let's say now this position right here is a long stock position, and it has with it a married put, just meaning that we bought the put. Now, if you take a look at this, the shares were purchased at $30.74. Now, had we had the shares only, we would be down $298 if we had the shares only. Well, the problem was the stock did not go up in our favor, meaning it didn't go higher than where we bought it. And we can see that price right there. However, the put gains value if the stock were to decline, okay? Or should, could. Now, if there's also some volatility as well, price is moving around more, could be the stock itself, could be the market, you could get the option that was purchased at 47 cents, it now becomes 2.15. So there's a gain on the protection. Okay? Well, how much did the protection make us so far? Answer, $168. So in one hand, we've lost $300, but on the other hand, we're up 168. Huh. Well, so this is where sometimes investors are not all the same. If this was my trade and paid money, we lost. But the thing is, a stock investor who did a stock investor, they're actually down 300. But in this case, we're actually down 132. I'm over here. So we've cut the loss by almost 2/3, okay? Just because we understood the concept of really what a put is and why an investor would do that. Now, we're 3 days to expiration. What did we talk about in this case? If we're set to close below the long put strike with 4 to 10 days to expiration, sell the put, sell the shares. That's what we talked about, right? Well, in this case, if we did this, if I right-click on the put where the gain is, create closing order, sell. Now, if I sell that, I'm trying to capture that $215. Now, the longer we wait until expiration, the harder the fill might be because there's less liquidity. It's expiring, okay? And now all of a sudden, if we go confirm and send, I'm going to now go ahead and try to buy it back for that, add the commission, send the order. Now, it fills. Now, if I right-click on that here, create closing order, sell. Now, here's the deal. Does the paper money account feel like a loser because it lost $133? No. Okay. It's barely the portfolio barely feels it. It's not even a 0.5% loss, not even a 0.25% loss. Okay. So the thing is, it's like a scar, like just a little bruise, barely, can barely see it. And so sometimes I want you to think about when markets pull back, yes, you could be over or wrong, but the question is, how much was it wrong? Okay. Now, let's also go back to just real quick. Now, the comment says, why not just exercise the put? Well, if you exercise the put by right-clicking on it, it would be selling 100 shares of stock. You sell 100 shares of stock, it would have knocked out like a bowling pin the 100 shares that you had. You're kind of getting to the same point, okay, which is you don't have any more position. Now, the whole idea behind that is if that stock is below the short strike, which was 30, it actually kind of leads us to believe that that stock might be, let's say the trend is in jeopardy, and maybe that's not necessarily a trend you really want to own. We're about 10% below that, okay? And there might also be other things that you might want to invest in that has a trend, okay? Now, let's actually go back to a couple other stocks I want to bring up. So if I brought up a stock like Cisco, okay? Now let's kind of start just like a new one, okay? Now, when markets have been more volatile, as we showed before, the bid-ask spread on those options are more volatile. Bid-ask spreads are wider, but they can also be more volatile too. Now, if I look at this just real quick, let's kind of talk about picking a strategy. Now, if you look at, let's say, Cisco, you're going to kind of see that we've been in the area of resistance for a while, okay? Now, if you're going to notice, some people might want to say, look, I'm going to wait for the breakout. But let's say I just say, look, I just want to get in. But I want to try to see, are the options more liquid? What would you say? Now, James, when you look at this table, what are you looking at initially? Oh, easy. I'm looking at the first out of the money call, and I'm looking at the first out of the money put. That's it. And I'm looking to see what's the spread there, 5 cents wide, 10 cents wide. This is the tightest we've seen today. Now, I'm going to imagine in this case that we said, oh, maybe we could buy the shares of the stock and buy the put. Example given like on Dr. Pepper, the previous example. Well, you got to remember is if the implied volatility is higher, the premium for that protection, downside protection, is higher. So let's kind of put it in just basic language here, okay? So let's say we buy the shares at $79. We buy them at $79.32, okay? We buy those shares at $79.32, and let's say we say, look, I want downside protection, and let's say we pay $1.75. Well, whatever you buy the put for, you got to add the put cost to it. So if we said in this case, hey, look, if we buy the shares at $79.32, now how many of you are with me? If we buy those shares at $79.32, that should be self-explanatory because that's what you see in the top left. But if we buy the put, we have to get the stock to go up by the amount of that put just to break even by when? Today or expiration? Expiration. All right. So we would need to go up to 81, okay, 07, just to break even. If this stock was at 79.32 at expiration, oh, I didn't lose. No, you did lose. You lost the option premium most likely. You lost $1.75. Now, if this stock, you have a right to sell it at $77.50. And then you can run and see what the risk is on that. Look at the difference in the stock price, add the premium to that. That would be about $1, if my math's right, $1.80 plus, it's probably about $3.60 worth of risk to the downside. That's the share loss plus the option loss. Now, in this given situation, someone might say, you know what, James, I kind of want to do more like a collar. The higher that the volatility is, buying shares of stock with downside protection, it's more costly. Remember, the way that we look at really what that cost is taking the option premium divided by the stock entry price. And the higher that percentage is, let me repeat that, whatever we buy the option for, what do we buy the stock for, and it's going to give us a percentage, okay? $1.75 divided by 79.32, it's going to give us 2.2%. We said, when we talked about, for example, doing a strategy like this, many investors would like to see this at a max percentage of 2%. Many would like to see it at 1.5%, because the higher the percentage is, the higher you pay for the put, the more the stock has to go up just to break even, okay? Now, a lot of times people give feedback on this strategy. A lot of times I've asked questions like, have you done this strategy before? No. So what you're asking is you're not giving conclusions based on actually practicing it. It's kind of more like questions, okay? So people have said, well, it doesn't matter what you paid for the put. It does matter, okay? And so the biggest actually thing is the investor's trying to have a lower put value so the stock doesn't have to go up as much. So there's a greater chance of being profitable. Now, if that volatility is outside that range, it's going to alter or change what the investor might consider. Step number one here is we're going to buy the shares of stock. Now, let's say, here's the truth. Do I know that the market's going to go up? Is that a direct question? Okay. Okay. Do I know the market's going to go sideways? Do I know that the market's going to go down? I have not an earthly clue. Okay. Now, here's the deal. So what this is doing is it's saying, look, I'm going to be somewhat bullish in this example. So if the investor says, look, I'm going to buy the shares, but I don't know. Okay. Well, if we did this, we're going to come down to single order, first triggers SEQ. And if we did this, let's say, look, I'm going to actually sell the 82.50. Now, what is that doing? What is that doing? Well, when you sell the 82.5 call, you actually agree to sell the shares at that strike price. Okay? So if you buy them at 79.25, you actually agree to sell them at 82.5. You wouldn't do it for free. Okay? You're saying bring a briefcase of cash. And you're saying, look, give me the $100 per contract. Okay? So now what you got, this is your classic covered call. Now, could the investor do a covered call? Yeah. Is there downside protection on this? Outside zero, no. Now, the investor might say, look, what I'm going to do is I'm going to use that premium right there to come over here and say, look, I at least want some downside protection. Wonder if things get crazier in the world. I mean, could you imagine? Now, if we look at this, I'm going to come over here to the put side. This has a little bit lower strike, but now we have the right to sell at 75. Now, this strategy is called what? What is it called? Now, technically, it's caller. We're going to call it really buy the shares, write the call or sell the call, and then protect, buy the put. Buy the shares, write the call, protect. Okay? So now when you take a look at this, the cost of this and say, well, how much really is the protection? Well, the net of these two is about 8 cents. Let's just say it's negligible, okay? The real situation comes is what's the max gain, max loss? And let's just bring these up just real quick right on the Analyze tab. Nice tool to work with here, okay? Now, what you're now going to see is I'm going to right-click, Analyze Risk Profile. Oh, there we are. Hits me right in the face. And all of a sudden now, this is man, when you can actually have tools and know how to use them, it's unbelievable, okay? So now all of a sudden, now we're going to work, okay? Let me get my tool belt on here. Now all of a sudden, I still can't fix anything. You could ask my wife. But the biggest actually thing, if you look at this, okay, I feel like we should have a co-class with Amber and I, just have like a couples investing webcast or something. That'd be fun. And then maybe add Jax maybe to that next one. And we could just, it'd be like a little meet and greet. Now, if we look at, let's say, Delta 44, what is that telling us? For every dollar that stock goes up or down, the position profit loss, unrealized gains, moves about $44. Gain or loss. So if this diagonal line is actually going to the upside, it benefits if the stock were to go up because it's a bullish strategy. The bad part about this strategy is it's capped. So if we said, well, on this position, what's the cap? Well, on this, if we take a look at this, it's going to be right about from 79.25 up to about, let's say, there, okay? So we can kind of look at the gain, and if we looked at this, you're going to see that gain is right around $300, and you can see that right there, right there. Now, James, how come your pointer, when you move that, it wasn't showing it? It's because it's taking today's price. We're talking about at expiration, okay? The expiration is in April. That's why when I moved my cursor, it wasn't showing a higher dollar amount, okay? We can change the date and then it would. Now, on the bottom side, if the stock were to close below that 75 strike, that's the put that we bought. Well, if it did, that loss is really about $400-ish. So this really kind of has, if we look at this, reward 300, and in this case, negative 400 if we were to close below, let's say, the 75. Now, let me kind of go back. 400. So someone might look at this and say, well, I always like to kind of have a trade where the gain is bigger than the loss. That's a forecast. That's not actual. It's a forecast. If you do a trade like this, it's really more built upon probability. The biggest actually thing about this is if this stock were to, let's say, go back to, let's say, or stay exactly where it is, the call and the put would typically offset each other, and the investor still has their shares. And now when that stock were to bounce around from here, there, all over there, it's only swinging with 44 delta, which is like having 44 shares of stock. These strategies of like a married put and a caller, for many investors who have experience, they still have shares, but they're using options to brace the stock position. It's like scaffolding, if you will. And so what it's saying is, look, I got some positions that I like, but man, the market condition, the sector condition, things that are outside this company, it's affecting my stock and it's causing my position to move left and right. And I want to brace that. Okay. Now, when you kind of consider these strategies, you kind of see that, hey, volatility does happen. That's reality. But it becomes a little more manageable. Okay. Now, the con about these are it does put a cap on it. And the thing is that expiration, it's not till kingdom come. It's only going to be the expiration till, let's say, the 17th. Now, could someone actually go farther out in time and try to put on protection? Yes. Okay. Have we done that historically? Yes. What's the farthest we've actually done that out? 70 to 100 days. Okay. Now, I'm out of my time, but what we're going to do is we're going to send the order, confirm send, and we'll send it. Okay. Now, hopefully today, we had a lively discussion here today, and I'm going to blame you. Okay. You guys were over the top today, and I appreciate that. Now, we got Camera Made coming up next. Later this afternoon, we got Barbara Armstrong teaching on technical analysis. Okay, getting started with technical analysis, so join her as well. And also, if you have not subscribed to this Trader Talk channel right on YouTube, do so. Join us. Don't feel like you have to learn this alone. As you can kind of see, you're a great group, and it's fun to actually meet other like-minded investors like yourself, and also kind of learn and practice together. Now, remember with what we actually talked about here today, it was done for example, illustrative purposes only. Learning investing does not have to be a lecture. It could be a lively, interesting discussion and fun. So with that said, remember with what we discussed, it was done for example, illustrative purposes only. Stay tuned for our next webcast coming up next. Take care. Bye-bye.